Hello, friends. How are you? Nice to be back. First, we have seen the receivable management, the introduction, and what is the benefits, and all the small introduction. And now you are going to work it out on an example. The example is mainly focused on whether we can take a decision, whether we can extend credit for a certain period or not. So we have to analyze the both pros and cons, benefits and cost. Okay, the benefits are more, then we'll extend the credit. If cost is more, or if the adverse consequence is there, then we need not go in for those extended credit period. Okay, we'll have to analyze and come to a conclusion. What is the benefit just by extending? Suppose you are giving 1 month credit. Now you decide to give 2 months credit. Okay, what is the benefit? Naturally, sales will increase. Natural sales will increase. Those people who cannot pay within a month, if you are given a 2 months time, they will think of availing and buying the goods from you, and you can extend 2 months credit. Then what's so naturally sales will increase, then naturally profit will increase. Okay, there's no doubt in that. But cost also will increase to some extent. Cost also, some other fixed cost, selling commission, all these things will definitely increase. One side, the cost. Other side is the receivables. You are creating receivables in your books. That means your money is blocked for 2 months in that receivables. Okay. So how will you rotate? So naturally, somebody has to finance those part of receivables till it comes back. Okay. So we'll produce a list of debtors, duly certified chartered accountant, go to the bank. If you are availing already limit, they will have to produce it, and they will extend credit. Of course, your margin will be bringing, and the bank will give maximum. Okay. So bank will charge some interest, some 20%, 12%, 15%. So that is a cost. That is a cost. Okay. One. Second cost is most likely that there is a chance for account becoming bad debts. So these two costs are there. Okay. So considering extra profits arising from extra sales on account of giving extra credit period, the cost that you are incurring on account of creating receivables, because money is blocked, because you are giving 2 months credit, you will get paid only after 2 months. We can stop the production, you can't stop the sales. We have to necessarily, somebody has to finance, so that production has to be continuous, sales has to be continuous. You will be supplying to customers. So naturally, you will take the assistance of banks or some lending institutions or friends who can lend it to you against this book debts. So they will be charging some interest. That is one cost. Yeah, another cost is there is a possibility that 2%, 1% of the sales may become go bad, because there's always possibility. Yeah. These two costs are there. So profit, the cost, which is better. So if the profit is more, then we can go in for those credits. So don't blindly follow just rules is 2 months, 3 months like that. Just I will look at it and find out whether it is beneficial for the bank, for the company to extend credit from 1 month to 2 months, 2 months to 3 months. Okay. Sometimes it is always beneficial. 2 months, if we extend, customer will happily will take the goods and go, because they have to pay after 2 months. 3 months still better, but there's a possibility that some of the accounts may go bad, and you'll have to incur losses, and it is to be written off against profit loss account. It will drain on your profits. All this thing will come, but still you stand to gain because of those performing book trades. Okay, so let us see that example and just find out how you are going to do it. Okay, so in this case, ABC company is there. The company, this annual sales is 10,000 units, number of units, and then at rupees 300 per unit. Okay, these are the first. So variable cost is 200 per unit. Fixed cost is 3 lakhs per annum. Okay, variable cost 200 per unit. Fixed cost is 3 lakhs. What is variable cost? I'll just explain when I talk on break here, but still I'm just telling you. Variable cost is one which varies with the production, which varies with the sales. Simple test. If it varies with the production, if it changes because of change in sales, changes because of change in production, it is called a variable. The all other things called fixed cost. Okay, fixed cost. What about the fixed cost? Rent. Okay, depreciation. Okay, this all fixed. Fixed in the sense it is doesn't change with regard to the period. It does not change. It does not change with the production. Even if you don't run the machine, even if you don't sell, that rent has to be paid to the owner of the building. Even if you even if you don't run the machine, but still depreciation has to be charged. Is a fixed assets. Okay, fixed expenses, fixed cost. So fixed cost is one component, variable cost another component. So fixed cost is why is it fixed? Because it is fixed with regard to period. Please understand. After the period, it may change, but it is not. It will not change with the production or sales. It's change with the period. That's called is period cost. Suppose you're taking a building on lease. You're taking a building on lease and you have to pay the rent every month. So every month the thing is fixed. For 1 year, if you take the lease for period for 2 years, the 2 years is fixed. After 2 years, the owner may revise the rent. That time it will change, but it is not changing. It does not. It's not changing with regard to sales or production. It is not varying with the production. It's not varying with the sales. So it is called fixed expenses. Please understand this. You should be able to find a difference between variable cost and fixed cost, because being a small business, you can easily analyze. I have analyzed very big what they call mills and textile mills. Also, it's very difficult to understand the word. Also, you can some certain wording, certain titles I don't understand even. I will have to ask the company what is that. What do you mean by this, like that? So, if for small businesses, it's very easy to you can easily analyze between what is variable, what is fixed. Okay, so now it's called fixed as cost is 3 lakhs per annum. Okay, so this is the present credit period. They are given one for all customers. They are given 1 month period. For all customers, they are given 1 period. Now they wanted to extend 2 months, 3 months. There is a proposal to extend the period from 1 month to 2 months, and also 3 months. They want to try. Okay. So now increase in sales for 1 month. They are already existing. Okay, no problem. Because of 2 months, there is a possibility that sales will increase by 15%. Okay, 15. Remember this. Then again, if you give 3 months, 30% just double. 30% sales will increase. Additional sales. Okay, it will increase. Then percentage of bad debts for 1 month, 1% of sales, bad debts. If you give 2 months, there's a possibility that 3% of sales will go as bad. Okay. If you give 3 months, 5% bad debts possibility. Okay. Fixed cost will increase by 50,000 if sales increase beyond 25%. Additional sales, if sales increase beyond 25%. So it comes here only. Third option. Third option. Okay. So it comes, if it increases by 20%, it becomes 50,000. Okay. The extra fixed cost will be, already fixed cost is 3 lakhs. If sales increases beyond 25%, more than that, then additional fixed cost will be incurred. Then it becomes 3 lakh 50,000. Okay, got the point? And return on investment in receivables means that 20% is a investment cost, because your money is blocked and you are getting financed by somebody else. He is charging 20%. That investment cost, because of blocking of capital in receivables, because the money you are not getting immediately, because he will pay after 2 months, he will pay after 3 months. So naturally, you have to go to the bank and you have to pledge these, hypothecate all these book debts and get your refinance, get a finance by the bank, and the bank will charge 20% on this advance. Clear? No doubt. Now we'll work it out. These are the things they are given. Now we'll have to find out whether 2 months is beneficial, 3 months is beneficial, what to choose. Already 1 month you are given. Already 1 month you are given to the customers. Now let us see how it goes. Now see, now the existing is first option 1 month, second option 2 months here, third option 3 months. Okay, clear? So what is the units is 10,000. So 10,000 into 300, 30 lakhs is the sales value for 1 month. Okay. If you allow 2 months, additional sales will be 15% over and above this. So then it becomes 11,500 units. So into 300, 34 lakhs 50,000. Clear? Then if you give 3 months time, 3 months credit period, then the sales will increase 30%. 30% means 13,000. So into 30, so 13,000. 13,000. Then the sales value is equal to 39 lakhs. Okay, now clear? 13 lakhs. So sales has increased from 30 lakh to 39, 30 1 month period. For 2 months, 34 lakh 50,000 increased 15%. Then for 3 months, if you give, it becomes 39 lakhs increased. Okay. Now variable cost. Variable cost is 200 per unit. So what is the unit total unit? 10,000. Okay, 10,000 units you are producing. What's the variable cost is 200. So what the variable cost? 20 lakhs. Okay. What the variable cost in this case? Into 200, 23 lakhs. Okay. For the third year, it becomes 26 lakhs. This is nothing but 13,000 into 200. Okay. So variable cost is 20 lakhs, 23 lakhs. Naturally, it will increase. No. Naturally, it will increase along with the production sales. I already told you. So 26 lakhs. Now contribution. What is contribution? It's just keep in mind, contribution nothing but sales minus variable cost. Sales minus variable cost is contribution. Why is called contribution? It contributes towards recovery of fixed costs and it contributes towards profit. You understand this? That's why it's called contribution. So okay, let's call contribution. So contribution consisting of two things. One is fixed cost plus profit. Contribution consisting of two things. One is fixed cost, then profit. So why is called contribution? I already told you. It contributes first towards recovery of fixed cost. Then it contributes to profit. For the point clear? So nothing to no confusion. Na? So contribution. When I take a break-even point, I will tell very detailed manner. Till such time, just remember this. Okay, contribution. So fixed costs, what they are saying already, fixed cost is 3 lakhs per annum. Okay, 3 lakhs, 3 lakhs. In this case, it changes because the sales has increased more than 25%. Sales has increased more than 25% because it is 30% no increase. What they are saying, if you increase by 25% more, then 50,000 extra fixed cost. Extra fixed cost. So 3 lakh 50. Okay. Now, fixed from contribution, you are reducing fixed cost. Then comes in the net margin. Net margin. Okay. So net margin is called actually net profit, but in this case we are not adjust the cost. That's why it's called a net margin. 7 lakhs, 8 lakh 50,000, 9 lakh 50. Got the point up to this? This is benefit. This is benefit. 7 lakhs, 8 lakh 50,000, 9 lakh 50,000 is the benefit on account of extending extra credit period. Got the point? Now, because of the extending this, you are getting 7 lakhs 1 month. If we don't give 1 month extra, you won't get 7 lakhs. No, because you are giving 2 months credit, the extra profit, the total profit has increased from 7 lakhs to 8 lakh 50. Okay. Because you are giving 3 months time, extra profit has increased by 9 lakh 50 from 7 lakhs. Okay. Now got the point. Now this is benefit. 3 options. 1 month, 2 months, 3 months. Now what is the cost? Let us see the cost. I already told you cost benefit analysis. Okay. Now investment. Now what is how much has been invested in the receivables book dates on account of extending credit to customers? What is the amount blocked in the receivables? They call receivables because the money has to come from him after 1 month, after 2 months, after 3 months. So how to find out? So you have to just find it very easy. So this is actually what is the variable cost? 20 lakhs. What is the fixed cost? 3 lakhs. So 23 lakhs is the cost of production. We are not taking profit into account, receivables, because bank will not what you call fund the profits. Bank will fund only cost. Okay, because profits is yours. So what they're saying is, so because 23 lakhs, this receivables, this is called receivables. 20 lakhs plus 23 lakhs. Always you can say like that. This simple easy, or else from this you reduce from profit, it becomes 23 lakhs, all the same. Okay, cost, total cost is variable cost, fixed cost. 23 lakhs is to be financed. Somebody has to finance. For how much, what is the amount? 1 month it is spending. So 1 by 12, 1,90,667. You got the point? This is nothing but credit sales. Nothing but credit sales. 20 lakhs, 3 lakhs. 23 lakhs is the without profit. It is a cost of, it is a cost, and it denotes credit, cost of credit sales. Okay, cost of credit sales. Cost of sales. Cost of sales. We can say cost of sales. So 20 lakhs plus 3, 23 lakhs for 1 by 12, 1 lakh 9266. Got the point? So this is the amount pending at any point of time on account of extending credit to your customer for 1 month. Okay. Now for 2 months, let us see. This what is the cost? Variable cost 23. What is the fixed cost? 26 lakhs. So 26 lakhs into 2, how many months? 2 months. 2 by 12. So you will get 4 lakh 33,333 is the amount outstanding in your account on account of extending credit to your customers for 2 months. Any doubt? Got the point? Now it's very clear now. So likewise, you just find out for the 3 months, it's like that. It's also 7,37,500. Just like 7,37,500. So you have to add both the cost. Okay, that is the total credit sales without profit into divided by 12 into 3 months. You will get this. Okay. So these are the amount blocked in your receivables. Amount blocked in your receivables. Somebody has to finance. So you are going to a bank is charging 20%. So straight away, what is the investment return on receivables is 20%. Take 20% of this. Take 20% of this, 38,333. Okay. Take 20%. Take 20% of this cost. This is the interest you have to pay. This is the interest you have to pay, right? Nothing is free. Bank is not giving any free loan. So 1,91,667 will be the 20%. So 38,333 is the cost. You have to pay interest. 20% on this. Okay. 86,667, right? 7,37,500 into 20%, 1,47,500. This is the cost, investment cost. Okay, because you have to pay to the bank. One cost. Another cost I already told you, book bad debts. So bad debts, what they are saying is 3%, 5%. Okay. So 3%, first year 1%, 30,000, 1% of sales. 1% of sales. 30 lakhs into 1%, 30,000. Back, it will not come back. It will not come. This is what your estimation. You assess. Like if you give 2 months, then 3%. 3% of what? 3% of your sales. Got the point? Always back the book debts, bad debts with refers to sales only. So 34 lakh 50,000 you are given, of which 3% is not coming back. It's becoming bad. That's all. 1,03,500. Okay, right? Got the point? And third, like similarly, becomes 5%. So it become out 39 lakhs into 5%. It become 1,95,000. So the total cost, these two, total cost is the total cost on account of extending credit period is add these two, 68,333, because this is investment cost. We have to go to the bank. Then bad debts, 63,33. If you give 2 months, cost is 1,90,167. If you give 3 months, it becomes 3,42,500. These are the cost. 1, 2, 3. B. Okay. What is the benefit? A. 7 lakhs, 8 lakh 50, 9 lakh 50. Now, what is the net result? So, what is the net profit? What is the net profit? Net profit means simply A minus B, because this is the benefit, this is the cost on account of extending 1 month. This is a benefit on account of extending 2 months. This is the cost on account of extending 2 months. This is a benefit on account of extending 3 months. This is a cost on account of extending 3 months credit period. Okay, I got the point. Now reduce it. 6 lakh. Now this is the net profit. 6,38,667. 6 lakh 59,833. Okay, got the point. Then 6 lakh 7,500. Let us see these are the net profit. Okay, say take this 6 lakh 7,500. This has come down. Net profit has come down. Net profit has come down 6 lakh something. It is not second 2 months you paid it, net profit is 6 lakh 59. Whereas if you give 3 months, it has come down 6 lakh 7,500. So what is the decrease in profit? 52,333. On account of extending 3 months, profit has come down. Profit has come down. How much has come down? 50 to 333. If give 2 months time, what the profit has come out from 6,31,659, 28,167 extra profit you are getting on account of extending for 2 months. So we can opt for 2 months. You need not going for 3 months, because if you go for 3 months, it results in decrease in net profit. Whereas if you go for second 2 months, it increase in enhancement of profit from 6,31,667 to 6,58,833. So net increase in profit is 28,167. So it is always better if you go in for the second option of extending 2 months credit period. Got the point? So always analyze the cost and benefit, then come to a conclusion. Don't blindly give 3 months, 4 months, and it will bite your profit. Very careful. Be very careful in doing this credit, extending credit. Though extending credit is a blessing, but you cannot blindly extend credit, then it will become problems. So take care of it, analyze, and come to a conclusion. I hope you have understood from me the simple principles behind extending credit. Friends, take care of yourself. God bless you. Thank you. Thank you for listening. Thank you.